And we need unity of decision for our actions. And we don't know how the neurons come to consensus to make decisions, but maybe there is a voting mechanism, I don't know. But there is no superiority or hierarchy among the neurons, and they make collective decisions together. And that's the beauty of nature. And it is interesting that the neurons actually specialize in different activities for different decisions. So, and they collaborate, they cooperate, and they work together to reach consensus for actions. So to model governance, we start with a very simple model for decision-making based on the work of Fama and Jensen. So we have initiatives, suggestions, and we have selection. So essentially, we need to generate different choices for making decisions, different decision choices, and then we need to select the best decision choice. So we need essentially two major processes. Of course, there is more to that, but the two essential parts of governance would be this. And in a corporation context, in a corporate context, we have, so value of the corporation is what matters. Essentially, we are going with absolute shareholder primacy. And we see that different choices are suggested, and we hope to select the best choice that results in the highest value for the corporation. And then different choices are generated, and then the best choice hopefully is selected. And so we need two main mechanisms here: generation of choices and selection of a choice. So there are different parameters in governance. We have to identify, so what are the options for governance? How can we govern? So there are many parameters, we call them factors here. And these parameters affect the quality of governance or the quality of outcome in 5 different ways. So I identified 5 different mediators for the quality of a governance mechanism. And of course, the quality of the outcome, we are assuming that the quality of the outcome reflects the quality of the process. So one of them is the number of suggestions. The other one is the average quality of suggestions. The other is the variance of the quality of the suggestions. And then we have the selection accuracy, the probability of selecting the best choice. And then we have the number of rounds, or the speed of going through the suggestion and selection stages. When I say suggestions, I mean the initiatives or the choices. So for the quality of the suggestions, we care about the maximum quality because we are aiming to select the maximum quality suggestion. And so each round, the quality would be defined as the increase in the value of the corporation or increase in the value of what we are designing. So if we go with the design process. So the increase or the value added or the quality added would be the quality of the suggestion. And when we have M suggestions, so they are distributed, they follow some kind of distribution, and the distribution of the best suggestion follows this formula, and the expected quality of the best suggestion follows this. For the distribution of the suggestions, we can make some assumptions. Actually, based on the experiments by Sakamoto and Bao, we see that the suggestions usually follow a normal distribution. So we can replace the normal distribution in the here for the suggestions. And so we get this formula. Unfortunately, we cannot find a closed form for this equation. I used MATLAB to simulate it. We can easily see that it is a concave function, and when the number of suggestions increases, we get a better, highest quality suggestion. So we can enter the other mediators into the formula. We can consider the other mediators, and at the end, we are gonna get into this. We are gonna get this formula for the quality of the outcome, essentially. And the quality of the outcome would be a function of 5 mediators. And of course, the sensitivity of the quality of the outcome or the performance of the process to different mediators can differ in different situations. So it depends on which situation we are. and we can have different, so a different mediator may be more important in the different situation. So in general, in my dissertation, I developed this generic architecture for governance that I tried to cover. So hopefully it covers almost all possible governance mechanisms so that we can test and compare different governance mechanisms in a systematic way. So just to be clear, it is a 14 tuple. It is modeled as a 14 tuple model, and we have 14 different parameters that we can change. So I developed a web application, as I mentioned, to experiment different governance parameters. We see the control panel here. In the control panel, we can specify the parameters for the governance. We can have different groups, different treatment groups to experiment each governance mechanism with several groups. And so I ran the experiments with Mechanical Turk. I recruited subjects from Mechanical Turk. I ran several experiments and tested many different governance mechanisms. But here, I want to focus on a new governance mechanism that I have proposed. So we can use the platform to evaluate and compare existing governance mechanisms, but now I want to test a new governance mechanism. So we talked about suggestion, but probably in many situations, the selection process is much more important than suggestion. So we want the selected choice to be the best choice. And the voting mechanism is susceptible to many problems. For example, the impossibility theorem. And that means any voting scheme violates at least one of the conditions of the impossibility theorem. Plurality voting violates the independence of relevant alternatives. And that means the agenda setter or so whoever sets the voting or designs the voting model can manipulate the outcome. So it is not all up to the shareholders to decide what decision should be made, and the agenda setter is important here. Also, we have tyranny of the majority. Someone with 51% of the shares can control 100% of the resources and decisions. And there is free riding. So many small shareholders do not have enough incentives to participate in decision-making process and in voting. And as a result, many shareholders do not participate. And sometimes we see that like just 30% of the shareholders participate, 30% of the shares will result in votes, will cast votes. And that means if you have 16% of the shares, you can control 100% of the resources. So with 16%, you can control the corporation. And there are many examples of this happening. So that institutions or institutional investors that control companies with a small portion of the stake in the company. And of course, this introduces a huge conflict of interest. So here I am introducing a new mechanism called parallel markets. In this mechanism, we do not use voting to make collective decisions. In this mechanism, we use the market equilibrium prices for shares of the company to detect the best decision and make the best decision for the company. And by best decision, we define the best decision as the decision that results in the highest price for the shares of the company. Absolute extreme shareholder primacy. So what happens is that, so this is the price of shares, the share price for the company. At some point, we face a decision, we face a decision issue, a decision matter. We want to make a decision. We generate the decision choices somehow, suggestions, and we have, let's say we have 4 decision choices. For each decision choice, we replicate the shares of the company, and we call them conditional shares. And those conditional shares can be traded independently in different markets in parallel. So after a period of time, they will have different prices based on the demand and the perceptions by the traders. So what the traders want, the buy and sell orders of the traders. And after a period of time, the conditional shares with the highest price is taken as the best version of the company, and its decision will be ratified as the optimal decision, and the other shares will be voided and the transactions will be reverted. So this way, we let the market select the best decision for us. So essentially, the algorithm is very simple. We generate the proposals, or we generate the suggestions or decision choices in a period of time. And then for each decision choice, we replicate the shares of the company, and we generate conditional shares for each decision choice. And then we have the selection period in which the participants, the traders, can buy and sell the conditional shares independently, as if they are different companies. Essentially, they are different versions of the same company, different futures of the same company. So if, for example, if IBM appoints this person as the CEO, or this person as the CEO, or this person as the CEO. So we have, let's say we want to choose which CEO, who should be the next CEO for IBM. So each potential CEO would be a choice, and would be a potential choice, and would be a potential future for the company. So so the traders can trade different choices, different versions of the company in parallel, and then the choice that results in the highest price for the shares of the company is taken as the best choice for the company. So essentially, we are maximizing the market capitalization. So we automatically maximizing the market capitalization for the company. So there are some accounting technicalities. I don't go into the details. It's a long story, but with accounting technicalities, we can implement it in the platform. And I ran some experiments to test if it actually works. So the experiment is very simple: 5 periods, 5 rounds, and in each round, the participants should decide which portfolio to invest on. So it is a mutual fund that is run by the shareholders. So the shareholders, the traders, actually should decide in which portfolio we should invest in each round. And so this is the instructions for the participants. So the first round, we have these options. The first option is just holding cash. The next option is this portfolio, this portfolio, this portfolio. So we should select one portfolio. And so this is the trading interface. So as you can see, we have the queue of offers and orders. So the orders, when the orders are submitted, they are not executed instantaneously. We need to wait for a counter offer to execute an order, to fulfill an order. And so that is how the double auction mechanism works. So after we run the experiment, the first round, as you can see, the prices of different conditional shares change like this. And at the end of the round, we see that the highest valued portfolio, has the highest price. So it's very interesting. And the second round, also the same. We see the highest valued portfolio, the portfolio with the highest value, has the highest price. So automatically, the market detects which choice is the best choice, and based on so the price reflects the value of the choice. And the same for the next round and next round. So almost in every round, the participants select the market selects the best choice. So the main problem with parallel markets is liquidity. So because when we have many markets, we are splitting the trades and the traders across several markets, and this results in thin markets. So it may take time to reach equilibrium prices. So we can just limit the number of choices or sort the choices to focus the attention of the traders to the most promising choices. But a better solution would be to use primary markets instead of secondary markets. So it is the idea of bonding curves or price function. What we do is that we use the price function to determine the price of the shares based on the number of outstanding shares. So each, for example, when the buy order is placed, when someone places buy order, we issue new shares and give them the shares or sell them the shares, and the price increases. When someone wants to sell shares, we buy back the shares and burn them, and the number of outstanding shares decreases and the price decreases. So essentially, we provide infinite liquidity to the traders, and we fulfill every order instantaneously. We do not need to wait for any counter offer. And of course, the integral of the price function would give us the fund, because price times the shares, the price of share times that would be just the funds that we raised with equity. Of course, with parallel markets, we have multiple prices on the price function. And so each choice will have a different number of conditional shares, and each conditional share would have a different price. So the interface for trading would be slightly different. For example, we don't have the queue of orders, unfulfilled orders here, because each order will be fulfilled instantaneously. We just changing the stability condition. So when we have a linear price function with that, the equilibrium point will be this, and it will be stable for RS less than 1. And of course, D should be positive. So we should just get loan. That means it's not like a bank that we give out loan. So if we want to give out loan, lend to others, so it would be a completely different story. So if you use a quadratic price function with that, so the equilibrium will be this, and so we have to solve the equation. We have to find the roots of the cubic equation, so this cubic function. So we have three possible values, three possible discriminants. So possible scenarios for discriminants. So if the discriminant of the equation is negative, the equilibrium would be this one positive equilibrium, and it is always positive as if RS is less than 200% return on investment. If this discriminant is 0, the equilibrium point would be this, and if the discriminant is more than 0, is positive, then we have 3 roots. 2 of them will always be negative and 1 of them will be positive, which is the only feasible equilibrium, which will be only feasible point. So you can see it's going to be like this. So this is the equilibrium point, and of course it is a stable equilibrium point, because again the slope of the value is less than the slope of the price function, and the other 2 roots are negative and not feasible. So there is one more thing, and that is when the fund changes, there are many financial events that can change the amount of funds that we have. So when the fund changes, then the integral of the price function is not equal to the equity fund that we have. So what can we do then? We have to adjust the price function. There is no way around it. So, for example, when we realize profit or loss, when we distribute dividends, etc. So, in the first situation, in the first scenario, we just move on the price function. But in the 2 other scenarios, we cannot move on the price function because the number of shares would be fixed. We have to adjust the price function. So there are 2 methods to adjust the price function, and one way is just is holding the price constant and then adjusting the price function based on that. So we just solve an equation and we get the new price function at the same point. So we are in the same price, we get the same price for the current outstanding shares, and we just have the new price function there. So if we have, of course, we have a quadratic price function, it's going to be like this. So we just move the price function, pivoting around the current equilibrium point. And that makes sense because we don't want to change the equilibrium point suddenly. It it destabilizes the market. The price should be predictable, essentially. And the other approach is just to hold the equilibrium constant and change the price function. So this is the easier approach to implement in smart contracts, because in smart contracts, the computational intensity matters. So here we have we need to do a lot of computations, but with this method, it's going to be easy. And so it's just multiplying it's almost like multiplying the coefficients. And so the limitations, first of all, the experiments, we had a small sample size, like I think 70 subjects, of course, a very thin market, but still, even with the thin market, we could get very good results, and that's interesting. We need to replicate the experiment multiple times to make sure that the results are reliable and consistent. No control group, of course, we have to compare the results of this experiment with another experiment with an alternative treatment, like, let's say, plurality voting, approval voting. Two groups with plurality voting, two groups approval voting, and two groups with parallel primary markets, two groups with parallel secondary markets, like 8 groups. And then that would be very interesting to see, okay, which governance mechanism works better, has better performance. So we can compare the performance of different governance mechanisms this way. So I just need budget for that. So, but the app actually can run multiple groups at the same time. So the web application that I have developed can just run multiple experiments at the same time. So, and there is a problem with external validity. Of course, the experiments are short, the length of experiments are short, group size is small, and the nature of the problem, so the decisions are very limited, specific decisions, just selecting the best portfolio to invest on. And so the contributions are the general model for governance, the unified architecture for governance, the web application that can run experiments, we can use to run experiments on, run experiments and test and evaluate different governance mechanisms, the new governance mechanism, the parallel markets or parallel secondary markets to be specific, and running that, testing that mechanism with online experiments, and also the parallel primary markets, which is, of course, completely slightly different from the parallel markets. So it can be applied in corporate governance, in collective design or collective intelligence systems, and DACs and DAOs and blockchain protocols. So just to be specific, I have developed a specific DAC that is actually based on the automated parallel primary markets. So the ParaLead.com is actually a specific DAC that is based on the parallel primary markets. And the smart contract is deployed into the Ethereum network. Actually, it is not deployed to the mainnet, it is deployed to Sepolia net. So we are testing the smart contract. So it's very complex buying a smart contract. And this is the front end that you see. There is no backend for this web application. It directly communicates with the blockchain, with the network, and it just uses Web3.js to send and receive information from the blockchain and from the smart contract. So yeah, and also I have a pending patent on it. So if you want, you can go here and read the white paper. It explains the mechanism for the parallel markets mechanism. And also you can go here and download the yellow paper to to see.
So you're trying to implement a DAO type environment, right? Being able to, right? I'm seeing, okay, do you really need the blockchain for this kind of
No,
decision?
we do not. Yeah, we do not need to. So I implemented it on a web application on a database. So
Okay.
when I ran the experiments, it was just on a web application. So of course, a company can just run it on. A company can just run it on. Sorry, let me just.
So if I wanna, suppose I have a model where I have, market data, customer data, product data, and industry ups and downs, and being able to figure out whether I am pricing my products right or wrong, right? Am I charging correctly?
So let's say you want to decide what should be the price for your
Yeah,
product.
am I underpricing my product and services,
Yeah,
right?
this is a decision. This is a decision. I don't think it is a very high level decision, but let's say you want to choose if you want to uh, just manufacture this particular product. So like
Okay.
an executive level decision, a governance level decision. So if you want to manufacture a particular product, so for this decision, what can we do? One approach is that we have the board of directors cast voting and cast votes and decide what to do. The other approach is that we have the shareholders vote. So we can vote, we can use voting mechanism or representative voting mechanisms in different ways.
Did
But
you implement this in a DAO situation, or that the DAO can make that decision on itself,
yeah,
right? Is
yeah.
that
So the DAC. So I call it DAC because it's a decentralized autonomous corporation. That is a particular kind of DAO.
Mhm.
So so yes, we can do that, but we don't use voting. We use the parallel markets mechanism. So we let the traders trade the versions of the company based on, let's say, manufacture this product or not manufacture this product. A very simple decision. So, and we see which version of the company has the highest price. So has the highest value for the company. And the traders will analyze the consequences of producing or manufacturing that product or not manufacturing that product. And then they decide, okay, if how much the company is worth if the company decides to manufacture the product, and how much the company is worth if the company does not manufacture that product. So, and so
And
this is
how was your experimental work in this space when I'm assuming you've been experimenting with the decision process, and how accurate have you been able to validate the output of these models,
yeah.
or yeah.
Yeah, so I showed you the results of the experiments are very consistent and very accurate. So essentially, the decisions were, okay, which portfolio we should invest on. So on which portfolio the company or the mutual fund should invest on. And the results were very consistent. So the highest value, the highest price was for the highest value almost all the time. So the best portfolio to invest on received the highest price after trading, even though the participants were just ordinary people, not experts in finance. But the market aggregates the information in price. So the aggregates all the information in price, and it is the magic of price. So price aggregates all the relevant information into one number, and the price reflects the value. So
So how would I so if I take a company, and we for example, your Xerox, right, was Japanese companies were eating its lunch at the lower end of the market. Okay, so this is in the late 80s, early 90s, right? So they faced a tough competition from the Japanese on copy machines. And they started, after the lower end of the market, and they came up even with innovative products, and Xerox was just totally lost in that upper. So if Xerox used your technique, right? And say, okay, Canon of the world, produce the a color copier for the low end of the market. I want to produce one. Should I produce what kind of, you want to make a decision about what kind of low end products you want to produce or compete with, right? I mean, if Xerox had a good understanding, the cost of developing a new copier at the lower end of the market. Let's assume, you want to have an AI engine, an autonomous AI engine that need to reconfigure everything, including the processes, right? So now you have autonomy of the decision. Now the salesperson might see just a new price that they don't even know, right? I mean, this is the idea of an autonomous organization. Does this stuff apply there in these kind of situations?
Yeah, absolutely. So autonomy is just the first step. So when you want to go autonomous, you have to be very careful. So when we have a smart contract in DAC, we want not to have a CEO or board of directors. Okay, that's the ideal. We want to get rid of the CEO and board of directors. However, what decision-making mechanism do you have there? So the governance becomes very important. It should not be sensitive to various manipulations. So it should, for example, it should not be sensitive to 51% attack, to impossibility theorem. So there are various things that we should consider. So if we have just a voting mechanism, so many DACs that I see around, they rely just on a voting mechanism, and they think they have solved the problem. But of course, they have not solved the problem. So we have the board of directors for a reason, and that was because the voting mechanisms are susceptible to many manipulation tactics. So we have the board. The board of directors was invented to control for that. However, the board of directors also is a result of a kind of voting mechanism. So it itself is the result of a voting mechanism. So they are trying to mitigate the problems with the voting mechanism with just using voting mechanism. And so we have this problem in traditional corporations and also in DACs, in autonomous corporations. So what I have done is that I just did not use the voting mechanism at all. I'm using a different mechanism, and now we can be actually autonomous. So ParaLead is actually an autonomous organization that does not need a curator, does not need an admin, does not need any kind of intervention, hopefully.
So what's before I pass it to my colleagues, then you might have mentioned it already, but what was the motivation when you started the project? Was it just to get rid of the voting mechanism, or what was the starting point, right? What problem we're trying to solve, right?
So one thing that I noticed is that there are many bad decisions made by CEOs and board of directors. Some of them are, we can say they're mistakes, but some of them are intentional. For example, as I mentioned, the astronomical salaries of the CEOs. Sometimes it is very difficult to justify them.
Right. And so you're taking the bias out of it, right? That's what you're trying.
The conflict of interest, that we see there. So there is an obvious conflict of interest there. So it all results from the voting. So because we are relying on voting, one way or another.
Yeah, well, the human element, right? Versus when decisions could have been made scientifically. Okay, all right. Thank you, Dr. Ramani. Omar, any thoughts?
No, first of all, thank you. This is very interesting. It's not within my area of expertise, but I was able to understand it. I'll start with a quick comment and then the question. So the price, you're basically trying to use the stock market price to help with the decisions. But this is also, the price is based on speculation. So back to the example you presented on a new product. So you have a new product, it creates a hype. The stock price goes up, but there is little value. So there's a mismatch between, the stock market price and value. But, I understand this is one of the, threats of validity of such work. Does your approach handle any uncertainty or confidence level? Making a decision, there is always a risk involved. And what is the time horizon? So if you have a new product within a week or a month or a year, maybe it has a negative value, but then on the long term, you have a new product and hopefully, revenue will go up.
Actually, very good point. So the beauty of market and price is that it reflects the future. It's all about the future. So it aggregates all the information about the future. So whenever anything wants to change, anything wants to happen, the first thing that reacts is the stock market. So let's say if there is gonna be